Shah from Envision Capital on the show with us. Nilesh, hi, morning. How's the lockdown treating you?
Well, Aisha, it's kind of first in a lifetime an experience like this, and honestly, it's pretty awful because the fact is that you have to essentially sit back, action is missing, and all of that. So I think one has only been trying to kind of keep one's calm in this environment and catch up with a lot of backlog of reading and all that kind of stuff.
Yeah, meditate, it helps. But Nilesh, what about the market? Because we were just chatting before the opening bell, and it's so strange because till about 3 days back, you wanted to just throw in the towel, sell whatever you have, whatever cash you could lay your hands on. And now you've got that feeling that, have I really missed the bus? Look at what the market has done in the last 3 days.
Surely, I mean, of course, from the lows that we experienced early this week, I think from there's been a strong bounce back. And obviously, of course, if you sold out, then of course there will surely be that left out feeling. But otherwise, I think on a week-on-week basis, I think it's pretty much kind of close to flattish market. Maybe yes, 4-5% here or there. But I still think that I think one should basically still try and wait for markets to stabilize. You'll always see these kind of up moves, sharp down moves. I think that's something which will continue. And in the very short term, we are going to be hostage to basically global cues. We've essentially, in the very short term, had this tailwind of news coming in from the US and the kind of stimulus that they have announced. And I think that's really kind of helped us to kind of climb back up from the bottom. So I think in the very short term, we are going to get guided by what's really happening the world over in terms of the markets.
Okay. So Nilesh, how does one differentiate between a bear market rally or a genuine durable bottom? Because if we are reacting to global cues, just like market cannot go down one way, they cannot go up one way. Last week market only went down one way. This week markets are only going one way. So how does one figure out that this is not the last call for people to get out and redeem their portfolios or perhaps raise cash?
Well, Nikunj, I think it depends on what is the perspective one has. If you probably kind of take a very short-term perspective, yes, you're going to have a trading rally, but essentially, I'm not entirely sure if the bottom is totally in place. One is not honestly at this stage very sure in terms of where this market could basically kind of try and consolidate. So what it looks like, I think, is that if one has not basically put money to work or anything like that, it's probably still better to wait. See news flow. I think most important of all is when is the lockdown getting kind of over. Keep in mind that we still have at least a couple of weeks more to go. It could possibly be even more. The other big thing about I think this whole experience of the episode this time essentially is this something which none of us have seen. Yes, we've seen the GFC, the global financial crisis in 2008-9, but that didn't impact the real economy. What you're really seeing this time around is a massive impact on the real economy. There are already estimates pouring out that we are going to basically hit a multi-year low in terms of our growth rates. The outlook maybe for at least Q1 of the next financial year is essentially not at all looking very comfortable. And I think that's probably somewhere around that period is when markets maybe could bottom out. So I still think that you're going to see this volatility depending upon global cues and things of that kind. But I think you probably will see even better opportunities going forward to basically put to work your dry powder.
So you are saying that you are not in a hurry to buy right now, and you feel that markets have gone up because of liquidity infusion, which means markets have gone up on steroid. It's a matter of time. The realization of bad news will hit us again, and then markets can come back and retest the recent lows.
Nikunj, I think when you hit these kind of lows, when there's such a massive shave off and you hit lows, most likely those lows do get retested. I mean, we saw this even during 2008-9, that the markets hit a low in October 2008. and retested or close to retested those lows in March 2009. And that laid the foundation for a massive bull market later on. This is something which markets, tend to do on most occasions. I can't recollect even one single occasion where there's been a shave off of say 40% or so on a Nifty, and there is a bottom, and then the bottom never gets revisited, or close to those levels never get revisited. Because I think yet so far we still think that back home there will be a stimulus and things of that kind, but essentially this time around maybe an immediate stimulus may not be of material help, apart from of course getting the market off from the lows, because I think the impact on some of the businesses is going to be very real, especially if the lockdown extends beyond April 14th. Then I think the impact would be significant. So I still think that if you have some basically cash left, it's better to basically wait out and see and see and look for better opportunities to deploy. There's no point trying to kind of now rush in when the markets have bounced back from 7,500 to almost 9,000. I mean, there has been a 20% rally already. So I probably think that I think a lot of the up move would have happened because of maybe short covering. It could have happened because selling is abated and things of that kind, but not for reasons beyond that. And you always have that after such shave off, you do tend to have some kind of these kind of rallies which take markets up by 15, 20, 25%.
What you're saying about, possibly retesting lows or just waiting and watching for a little while. Still want to ask you though, in terms of possibly what could look attractive, where you would first want to invest should you find that opportunity, what would it be?
Yeah, sure. So I think that's a great question. And I think what you're going to see in the very short term is basically clearly it's going to be the banks and the financials which are going to hold sway. And therefore, I think for short-term traders or short-term guys or people with a short-term perspective should continue to be focused on that segment, because obviously the shave-off has been maximum there. And then you're going to get pretty aggressive and violent price moves out there. So I think in the very short term, continue to be focused on the banks and financials. But obviously within that, I think just stick to the top tier names and stick to those banks and financials where the business is pretty much non-discretionary, which means things like basic banking or things like, say, general insurance, for example, where you need to keep buying your health insurance policy and your property insurance and your motor insurance. I think the next step should essentially be to look at those kind of businesses where there will not be a demand destruction. I think that's very, very important. And I think there are three pockets where I think there is not going to be material demand destruction. One is essentially the staples. Look for consumer staples. I think a lot of tier 2 consumer staples prices have got shaved off. Valuations have become attractive. And I don't believe that they are going to have anything like a material degrowth or anything like that. The second area, of course, is pharmaceuticals. Clearly, I think you'll need to keep buying your medicines. So I think there again, I don't think there's going to be demand destruction. The third area, of course, is going to be utilities. I think again, in the case of utilities, there is essentially demand is going to kind of prevail. And I think when I say that during, of course, the lockdown, there's going to be, of course, less consumption. But obviously, post the lockdown, demand is going to bounce back for these kind of pockets. So I think it's going to be attractive consumer staples, pharmaceuticals, and utilities. And then, of course, look at some of the discretionary consumer kind of companies. That probably should be essentially the last pocket that you want to really focus on. So I think for now, very short term, be focused on banks and financials, more the non-discretionary side. And similarly, I think from a medium-term perspective and for the immediate period beyond the lockdown, look for attractive consumer staples, pharmaceuticals, and utilities.
Nilesh, as you mentioned, growth is going to hit a multi-year low. Expectations from the RBI today that we're going to see at least 50 basis points, if not more, as well as, of course, an acknowledgement and solution, to the moratorium on loans, for instance, and other measures along those lines. what would you want to hear today? What would you suggest would keep markets, and corporates, happy at this point? We're already seeing that move on the back of that. We're already seeing, that anticipation build up.
Well, I think in terms of the rate cut, I think majority consensus must be expecting a rate cut, but probably that's the last thing which the RBI should do. They should keep powder dry. I think right now a rate cut alone will not help, because I don't think anybody out there is going out there to borrow and things of that kind. You still really don't know the after effects of the lockdown. So I'd probably say that a rate cut should probably work better when we are close to basically the lockdown getting lifted. So I think basically the RBI should essentially reserve that kind of thing, the rate cut, for a later date. I think today what should basically come out is basically relaxations. That if you have EMIs which are payable soon, if you have credit card stuff which are payable soon, and all of that, I think there should be relaxations there. Timelines need to be tweaked and all of that. So today it should be a day of relief and relaxation in some of those financial commitments which all kinds of people would have, be it individuals, be it corporates, be it HFCs or NBFCs who have refinancing commitments, MFIs who again would essentially have refinancing commitments. I think clearly today should essentially the entire focus should be around these things and not on the rate cut.
So, Nilesh, are we in for what could be called as a gorilla market where you need to be smart, 15, 20, 25%? If you make these bouts, get out, let the market decline. What should one do? I mean, we say long term, but just about everyone who's come on the channel last 2 days is saying that don't be in a rush to buy. Don't buy right now because we are not out of the woods yet.
Yeah, so obviously, of course, this is essentially a great time for traders who can act like gorillas and essentially time the moves, which means that, if you're a trader and if you bought 3 days back and essentially you try to sell off. But Nikunj, I think at times some of these discussions just become, nice on paper and they're nice theoretical discussions because it assumes that you've got the bottom and you've been able to exit at the peak. So I think yes, if you're a sharpshooter, you're a trader, I think it works pretty well. But otherwise, yes, I think this is probably for the first time that you are going to see such a large impact in terms of financials. I think in my last 20-25 years, I have not seen situations where you're really staring at a potential earnings degrowth. If not maybe for a full year, but surely even for 1 quarter. And I think that is a significant thing. I think there is going to be a reset in terms of lots of businesses. I think a lot of businesses with leveraged balance sheets are going to get impacted hugely and probably get impaired permanently. So I think that is the kind of scenario one is staring at. And therefore, I still think that, yes, these kind of situations create great long-term investment opportunities. And I think one should try and be well positioned for that. And I think the only way to position oneself well for that is to keep looking at things and let things stabilize. And just kind of giving you a small perspective that let's assume you thought that here is a business which has got kind of knocked down in terms of the valuations. And if you think that, say, over the next 5 years, this could be a potential 3x, which means 100 going to 300, honestly, it's not going to matter whether you bought that at 110 or 120 instead of 100, provided you obviously have the conviction that, yes, in the next 5 years, this is going to be basically a 3x. So I think that's why I probably think that it might just be a good idea to take a step back, see how things are evolving, and then probably commit additional capital.
Okay. What have you bought in this fall, Nilesh? I mean, assuming that prices got really great 2-3 days ago, did you use some cash, or you are convinced that, look, we are in for bad days, capital protection, minimizing risk is more important?
So I think, Nikunj, what we have essentially been doing is buying into some of our existing positions. So we've added in banks, financials, cement name. These are some of the names that we have essentially added where we thought that essentially the prices have become terribly attractive. So we've essentially been adding a bit of these kind of things here, but we still continue to hold some bit of cash out there.
Okay. What are the top three holdings, Nilesh? Can you give me a sense of that?
I think probably the top 3 or 4 would be, I think one is, of course, what we own is Zydus Wellness across all our portfolios put together. That's our number one holding. It's I think a consumer staples business. We don't think there is going to be demand destruction out there. The second is essentially an IT services company. Of course, there are going to be a bit of challenges in terms of the headwinds that they'll face in terms of how the US markets and all evolve. But I think it should be fine once things settle down. And then, of course, we own a leading general insurance company. We own that, and we think that's essentially, again, a non-discretionary spend. And then we also own we own a leading asset management company which runs India's largest mutual fund business. So I think it's a mix of stuff that we own between consumer staples, financials, as well as IT services.
But no private banks. That's unusual. A fund manager coming on my show and saying that, look, my top 4 holdings, that does not include a private bank. How unreal is that?
Yes, so we've essentially been light on banks, and I think that's been a huge positive. We own a couple of large private banks, not large, but we own a couple of private banks in a relatively smaller way, and they're not across the board. They're not amongst our top 3 or 4 holdings. But would they be part of our top 10 holdings? Yes.
Nilesh, what happens to IT? Because you own an IT company. I'm not getting into IT, the stock which you own, but IT company is IT business is a manpower dominated businesses, which is 30% onshore, 70% offsite. So yes. 30% on-site, 70% offshore. Now there's a lockdown. IT companies are not being classified as essential services with the exception of BPO and back office. So in a lockdown, when manpower will not reach the offices, what happens to their delivery? What happens to their deadlines? We've never seen something like this before, so I don't know how to fathom it.
Yeah, no, I think, Nikunj, that's a pretty valid point. And I think it's going to be challenging times for the IT services companies. And like what you've rightly said, that it's essentially a people-driven business. And I think we've been speaking to the IT companies and they've been hosting conference calls in this environment. And I think in this environment, their focus essentially is on business continuity. And in fact, one of the IT services companies actually said that they have essentially been able to kind of have 90 or 95% of the people, both on-site as well as off-site, they've been able to get them to work from home. So I think in a way that's pretty exemplary that they have been able to rise to the occasion and ensure that delivery of services has not been disrupted. So I think in a way their ability to service their existing clients is not yet materially disrupted. I think the bigger challenge, Nikunj, for some of the IT services companies is going to be that would some of those companies or some of their clients, would they essentially in a way get disrupted, go bankrupt, and then they have issues of payments. So I think there is going to be some stress in terms of their billing revenue growth, their collections, some impact on working capital. I think all of that, and especially I think if this all continues for maybe another month or so, it should be fine. But if it extends beyond a month, not just in India, but I think the world over, if this continues for some more time, then I think several businesses, including the IT services business, is going to be under tremendous pressure. There will be challenges of growth. There will be challenges of collections, working capital, receivables, all of that. So yes, I think right now we just probably got to keep our fingers crossed and hope that that this whole thing dies down maybe in a month from now totally. But otherwise, yes, there will be challenges. So I think right now, I think most of these companies are not facing challenges in terms of business continuity. Is it easy out there? Definitely it is not easy out there. But business right now in terms of the delivery is continuing.
Tough times ahead for most of these. But Nilesh, good to have you on the show. Stay safe and we'll speak again soon.
Thank you so much.